Hello everyone, hope you're doing well. Okay, today we're gonna go through the introduction to financial statement and financial statement analysis. And we're gonna see that how can we analyze the performance of the companies and how to produce financial statements. Chapter outline: firm's disclosure of financial information, the balance sheet, the income statement, the statement of cash flows, other financial statement information, financial statement analysis, and financial reporting in practice. Learning objectives: list the four major financial statements required by the SEC for publicly traded firms. Define each of the four statements and explain why each of these financial statements is valuable. Discuss the difference between book value of stockholders' equity and market value of stockholders' equity. Explain why the two numbers are almost never the same. Compute the following measures and describe their usefulness in assessing firm performance: the debt-equity ratio, the enterprise value, earning per share, operating margin, net profit margin, accounts receivable days, accounts payable days, inventory days, interest coverage ratio, return on equity, return on assets, price earnings ratio, and market to book ratio. Discuss the uses of the DuPont identity in this aggregating ROE, return on equity, and assess the impact of increases and decreases in the components of the identity on ROE. Describe the importance of ensuring that valuation ratios are consistent with one another in terms of the inclusions of debt in the numerator and the denominator. Distinguish between cash flow as reported on the statement of cash flows and accrual-based income as reported on the income statement. Discuss the importance of cash flows to investors relative to accrual-based income. Explain what is included in the management discussion and analysis section of the financial statements that cannot be found elsewhere in the financial statements. Explain the importance of the notes to the financial statements. List and describe the financial scandals described in the text along with the new legislation designed to reduce that type of fraud. Okay, firm's disclosure of financial information. Financial statements. Firm issued accounting reports with past performance information. Filed with the SEC, Securities and Exchange Commissions. Form 10Q should be filled up and published every quarter, and Form 10K should be filled and so it should be filed and also published annually. Must also send an annual report with financial statement to shareholders. The reason that we need to have the financial information and financial statement actually is to make sure that everything is proper, everything is recorded in order to protect the investor's right. Preparation of financial statement, generally accepted accounting principle, GAAP. It means that we need to follow the GAAP standards. Auditor, neutral third party that checks an annual firm's financial statement. When the company produces the financial statement, there is possibility that could be some problems, some issues. Then we need a neutral party or auditors go through it and verify that everything is in order and proper. Four main types of financial statements: balance sheet, income statement, statement of cash flows, statement of stockholders' equity, which also is called a statement of retained earnings. Balance sheet, a snapshot in time of the firm's financial position. It represents the assets owned by the company and the claims against those assets. The balance sheet identity or the equation looks like asset on the left side equal to liability plus stockholders equity, which later in detail we're going to see what comes under the asset, liabilities, and stockholders equity. Okay, assets, what the company owns, liability, what the company owes. And stockholders' equity is the difference between the value of firm's assets and liability. It's quite simple and straightforward. This is an example of the balance sheet, asset, liability, and owner's equity. And we can see that under each category we have different components. And this balance sheet is for year 2016, 17, and also here shows the change between these 2 years. And left-hand side numbers, for example, for the year 2017 should be equal to the right-hand side numbers for the year 2017 or 2016. Assets. Current assets, cash or expected to be turned into cash in the next year. In a way, most liquid assets comes under the current assets, like cash, marketable securities, accounts receivable, AR, inventories, other current assets. Example would be prepaid expenses. Okay, long-term assets. See the name also, it's quite obvious that the property, plant, or equipment gonna go under this category. But we're gonna go with the net property. Then how to net property or net plant or equipment means that depreciation should be deducted from it. Depreciation and accumulated depreciation is book value equal to acquisition cost, the amount that we bought the property or the plant or the asset, minus accumulated depreciation. And also under the long-term assets, we have goodwill and intangible assets, like the brand of the company. Amortization. Amortization look like the depreciation, but for the intangible assets. And other long-term assets. For example, investment in long-term securities will come under the long-term assets. That's an example for the company. It's called Global Conglomerate Corporation Balance Sheet. That we can see the current asset, its components, and long-term asset and its component. And here shows the total asset for year 2017 and 18. Okay, on the right-hand side, one of the elements is liabilities. Current liabilities due to be paid within the next year. Accounts payable means AP. Short-term debts or notes payable. Current maturities of long-term debts. Other current liabilities, which is taxes payable and wages payable. And also net working capital, considered as current assets minus current liabilities. And another component under the liability is, or the category is long-term liabilities. These long-term debt, capital leases, and deferred taxes. Taxes that company owes to the government. Okay, this part also shows the current liabilities and long-term liabilities with its components. And the liabilities for year 2016 and 17. Okay, next component of the equation is stockholders' equity, book value of equity, book value of assets minus book value of liabilities. It says that it could be possibly negative. Many of the firm's valuable assets may not be captured on the balance sheet. Okay, Market value versus book value. Market value of equity, or in another form, is called market capitalization, or the market cap, is equal to price per share multiplied by the number of shares outstanding. And of course, market cap cannot be negative. Why? Because the limit for the price, the minimum, is 0. 0 multiplied the number of shares could be 0, and it cannot be negative. Often differs substantially from book value, of course, because the price per share can change every day, every moment. And then it's not gonna be same as the book value of the asset. Okay, market value versus book value, or also it's called price to book ratio, is market value of the equity divided by the book value of the equity. Is one of the ways of evaluating the stock of the company, or the value of the company actually. And if this ratio is low, means that's the value of stocks, and if it is high, it's the growth stocks. It depends on the strategy of the investors, that what type of investor they are, and they're gonna decide. They're gonna buy the growth or the value stocks. Okay, enterprise value, or the total enterprise value, can be interpreted as the cost to take over the business. It means that if you want to buy any business, you need to calculate the enterprise value, which is equal to market value of equity plus debt minus cash. Here's an example. If Global has 3.6 million shares outstanding, and these shares are trading for a price of $14 per share, what is Global's market capitalization? How does the market capitalization compare to Global's book value of equity in 2018? Global's market capitalization is 3.6 million shares multiplied by $14, which is $15.4 million. This market capitalization is significantly higher than Global's book value of equity of $22.2 million. Thus, investors are willing to pay 15.4 divided by 20.2, the book value, equal to 2.27 times the amount Global shares are worth according to their book value. And this is the balance sheet for the Global Conglomerate Corporation. Okay, how to calculate the enterprise value? We get all these numbers from here. That is 50.4 million plus 116.7 million, which the 116.7 million comes from 3.5 million notes payable, 13.3 million of current maturities of long-term debt, and remaining long-term debt of 99.9 million minus the cash 21.2 million, equal to 145.9 million. There's a question that you can just go through and do it by yourself, which is quite easy. Calculate the market capitalization and the market to book ratio. Okay, income statement got other names, a statement of financial performance or bottom line. And it shows the income of the company, or profit after tax, or net income of the company. Okay, how to calculate the net income or profit after tax of the company? We start from the total sales or revenues minus cost of sales or cost of goods sold equals to gross profit. The gross profit minus operating expenses, which includes selling, general and administrative expenses, R&D, Depreciation and amortization equals to operating income. Operating income, either minus or plus other income or other expenses, equals to earning before interest and taxes, which is called EBIT. EBIT minus or plus the interest income or interest expenses, equal to pre-tax income or profit before tax, minus taxes, equal to net income or profit after tax. That's an example. It starts from total sales or revenues and it goes up to net income. The net income divided by the number of the shares produces the earning per shares. But we also sometimes calculate the diluted earning per shares. Why? If the company has given some stock options or has convertible bonds. If the convertible bonds converted to the number of shares, or if the stock options is exercised, the number of the outstanding shares changes, then earning per share is gonna change to the diluted earning per shares. And this is another form of showing the income statements. Earnings calculation, earning per share, net income or profit after tax divided by shares outstanding. The number of shares outstanding need to be adjusted if stock options is granted to the higher management or convertible bonds are exercised. Then we're gonna calculate the diluted earning per shares by the number of the outstanding shares gonna change. Okay, statement of cash flows. Cash in, cash out. How the company's cash flow works. We're gonna see it in the proper and organized format. Net income typically does not equal the amount of cash the firm has earned. For example, firm earned an income of $5 million. Cash account decreased by $65 million. Why such a thing happens? There could be few reasons. Accrual accounting, the way that we record the expenses and the incomes. Non-cash expense items like depreciation, right? Depreciation is a non-cash item that which we include in the income statement, but is not a really cash that we pay out. Preference to classify interest expense as part of financial cash flow. Okay, the statement of cash flows could be divided or categorized in three different forms. It means that the money that comes in the company or goes out of the company can be categorized in these three forms: operating activity, investment activity, and financial activity. Operating activity adjusts net income by all non-cash items related to operating activities and changes in the net working capital. Means we're gonna add back the depreciation. If there is an increase in the account receivable, then it will be deducted from the net income, and if there is increase in the accounts payable, it would be added. An increase in the inventory is gonna be deducted. I'm sure you understand the logic behind. Accounts receivable is the money that we're supposed to receive. When there is an increase in the accounts receivable, then means the money is not coming in the company. That's why it should be deducted from the net income. Accounts payable is the money we're supposed to pay, but the increase in the accounts payable means the money is staying in the company, it's not going out. Then that would be an increase to the net income. And also same story for the inventories. When there is increase in the inventory means we are paying in order to buy some goods to stock in inventory. That's why it should be deducted from the net income. Okay, another category is investment activity. The cash required for investment activities. Capital expenditures, which is called CapEx. Buying new property, plant, equipment. Buying or selling the marketable securities also. The last category is financing activity. Cash flows from financing activities. Payment of dividends. Retained earnings equal to net income minus dividends. And also changes in borrowings would be included in the financing activities. An example here is the operating activities. Here is financing activities and investment activities. And here shows the numbers for two different years, 2017 and 2018. Which for the operating activities from 0.2 has dropped to 1.2. Yeah. And the investment activities from negative 6 million went to negative 21 million. But the financing activity from negative 1.3 million went to positive 1.7 million. Sorry, from 4.5 went to 23.9, but the changes in total from negative 1.3 went to 1.7. An example, suppose Global had an additional $1 million depreciation expense in 2018. If Global tax rate on pre-tax income is 26%, what would be the impact on this expense on Global's earnings? How would it impact Global's cash balance at the end of the year? Depreciation is the non-tax item. It should be added to the operating activity. Okay, see. Yeah, this 1.2 gonna go to 2.2 and this 10.4 gonna change to 9.4 and 9.4 here, then deduct 7.7. All these numbers respectively gonna change. Depreciation is an operating expense. So Global's operating income EBIT and pre-tax income would fall by $1 million. This decrease in pre-tax income would reduce Global's tax bill by 26% multiply 1 million, which is equal to $0.26 million. Therefore, net income would fall by 1 minus 0.26, which is equal to $0.74 million. On the statement of cash flows, net income would fall by $0.74 million, but we would add back the additional depreciation of $1 million because it's not a cash expense. Thus, cash from operating activities would rise by negative 0.74 plus 1 equal to $0.26 million. Thus, Global's cash balance at the end of the year would increase by $0.26 million. The amount of the tax savings that resulted from the additional depreciation expense. There's another example. Please go through it by yourself, which is quite easy. Other financial statement information. Several other pieces of information contained in the financial statements weren't mentioned. The statement of stockholders' equity, the management discussion and analysis, notes to the financial statements. Okay, statement of stockholders' equity equal to changes in stockholders' equity equal to retained earnings plus net sales of stock When you sell things, money comes in. Equal to net income, means profit after tax, minus dividend. If you pay any dividend, is minus, plus sales of stock by money comes in the company, and minus the repurchase of stocks, because you need to pay in order to buy back the stocks. Management discussion and analysis of balance sheet transactions. Transactions or arrangements that can have a material and significant important impact on the firm's future performance, yet do not appear on the balance sheet. Means we're going to produce another report which is called Management Discussion and Analysis. Another statement is called Notes to the Financial Statement. And here we're gonna mention what methodology we have used in order to calculate the different ratios and different elements. For example, for the inventory, we have used LIFO or FIFO method. Which one? Yeah. One question. In the segment results section of its financial statement, Hormel Foods Corporation reported the following sales revenues by reportable segment product category for 2016 and 17. Grocery products, refrigerated foods, Jenny-O Turkey store, specialty foods and international and other. Which category showed the highest percentage growth? If Hormel has the same percentage growth by category from 2017 to 18, what will its total revenue be in 2018? Okay, it's got easy. We're just going to calculate the simple ratio actually. The percentage growth in the sales of grocery products was 4.6%. How do we calculate this percentage? Means number in 2017 minus number in 2016 divided by 2016 multiply 100. Another way of doing it is 2017 divided by 2016 minus 1 multiplied by 100. Similarly, growth in refrigerated foods is negative 5.2%. For this category is negative 4.5%. Another category is negative 15.4%. And international and other groceries were 6.7%. Thus, international and other categories showed the highest growth. See? If the growth rates continue for another year, sales of grocery products will be the number from 2017 multiply the growth rate here equal to 1 million, and the other categories will come around 4 million, 1.5 million, 672 million and 581 million respectively, for total revenues of $8.9 billion, a 3.4% decrease from 2017. We are just multiplying this number, if it is negative, it is positive, with the numbers in each category for year 2017. Okay, there is another example. Please go through. You're supposed to calculate the operating segment had the largest percentage change and the largest dollar change, which is for Japan, and the biggest dollar change also is for America. Okay, we have produced the financial statement, but what's the usage of that? What we're gonna do with that? We're not just gonna keep it. We need to make some sense feeling out of that, then we need to do some ratio analysis. Financial ratios are relationships between different accounts from financial statements, usually the income statement and the balance sheet, that serve as performance indicators. Being relative values, financial ratios allow for meaningful comparison across time between competitors and with industry averages. Used to compare the firms with itself over time. You want to know that in different years, how are you doing? And compare the firm to other similar firms. You want to know that how are you doing relative to your competitors. Okay, financial ratios. 5 key areas of a firm's performance can be analyzed using financial ratios. Liquidity ratio can the company meet its obligation over the short term? Solvency ratio or financial leverage ratio talks about that. Can the company meet its obligation over the long term? Previous one was short term, this is long term. Asset management ratio, how efficiently is the company managing its asset to generate sales? Profitability ratio, how well has the company performed overall? Market value ratio, how does the market investors view the company's financial prospects? We also can conduct a DuPont analysis, which involves a breakdown of the return on equity, ROE, into its 3 components: profit margin, turnover, and leverage. Okay, the first category is profitability margin, which we calculate the gross margin and operating margin with these formulas. You do not need to memorize any formula. And also we have EBIT margin, we have net profit margin as well. And this graph shows the margins for 5 US airlines from year 2017 up to 2018, which for most of the years from 2009 to 2017, Alaska Airlines doing better. Another category is liquidity ratio, which we can calculate the current ratio, current asset divided by current liabilities, quick ratio, and the cash ratio. Here's an example. Calculate Global's quick ratio and cash ratio. Based on these measures, how has its liquidity changed between 2017 and 18? Okay, in 2017, Global's quick ratio was 0.74 and its cash ratio was 0.44. In 2018, these ratios were 0.83 and 0.44 respectively. Thus, Global's cash ratio remained stable over this period, while its quick ratio improved slightly. But also, these liquidity measures have not deteriorated. A more worrisome indicator for investors regarding Global's liquidity might be its ongoing negative cash flow from operating and investing activities, shown in the statement of cash flows. Another question, please you go through it by yourself. And the quick ratio for 2017 this much, and dropped to 2018. Cash ratio also dropped from 2017 to 2018. Using either measure, Ryland's liquidity has deteriorated. Okay, working capital ratios measure how efficiently a firm is using its assets. to generate revenues or how much cash is being tied up in other assets such as receivable and inventory. That's a definition for working capital ratios. And of course, there are a few different formulas and way of measuring the working capital ratios. Accounts receivable days, accounts payable days, inventory days. Accounts receivable days, it shows number of days take to collect payments from the customers. And accounts payable days shows number of days take to pay to the supplier. Means if we can reduce the accounts receivable and prolong the accounts payable is much more better for the company. Okay, accounts receivable turnover, that's how we measure it. Annual sales divided by accounts receivable, accounts payable turnover, annual cost of sales divided by annual payable, accounts payable, and the other one is inventory turnover, annual cost of sales divided by inventory. Okay, interest coverage ratio. This EBIT divided by interest or EBITDA divided by interest. How to find the EBITDA? EBIT plus the depreciation and amortization. As an example, assess Global's ability to meet its interest obligation by calculating interest coverage ratio using both EBIT and EBITDA. In 2017, this ratio was 1.54 and 2018 is 1.35, is reducing. And the other ratio from 1.78 went to 1.51. In this case, Global's low and declining interest coverage could be a source of concern for its creditors. But if the company is not able to pay its debt and interest to the creditors or the bank. There is another question, please do it by yourself, which is quite easy. We have all the numbers here, which see in 2017 is this much, went up to 2018 to 10. Also, there is an improvement from 2017 to 2018. Using either measure, Ryland's ability to meet its obligation is very good and improving. Another category is leverage ratios, which extend to which the company relies on debt as a source of financing. Because one source of financing is the equity, another one is debt. But for the debt, you have obligation because you need to pay the interest and the principal to the creditors and the bank. Okay, debt to equity ratio, total debt divided by total equity, and debt to capital ratio. Total debt divided by total equity plus total debt. Leverage ratio, also net debt, is needed for this part. Total debt plus excess cash and short-term investment. Debt to enterprise value is net debt divided by market value of equity plus net debt. An equity multiplier is total assets divided by book value of equity. Okay, another category is valuation ratio. PE ratio, price divided by earning per share. Market capitalization divided by net income, or share price divided by earning per share. And also enterprise value to EBIT and enterprise value to sales. There's a question. Consider the following data as of February 2017 for Walmart and Target, two different corporations, in billions. We have the sales, EBIT, depreciation, net income, market capitalization, cash, and debt. Compare Walmart's and Target's EBIT margins, net profit margins, PE ratio, and the ratio of enterprise value to sales, EBIT and EBITDA. Okay, Walmart and EBIT margin of 4.7, a net profit margin of 2.8, and P ratio of 15.7. And the enterprise value is 252.9 billion, and the ratio is 0.52 to sales. And we can calculate the same thing for the target company, and we can compare these two. Note that despite the large difference in the size of two firms, their valuation multipliers are comparable. Walmart trades at a somewhat higher earnings multiple, whereas Target trades at a higher multiple of sales, likely due to its higher profit margin. There is another question. Please look at it by yourself and do it at home. Okay, operating returns often evaluate the firm's return on investment by comparing its income to its investment using ratios: return on equity, return on assets, return on invested capital, book value of equity plus net debt. Assess how global's ability to use its assets effectively has changed in the last year by computing the change in its return on invested capital. Okay, in 2018, Global's return on asset was 5.5% compared to return on assets 2017, which was 4.4%, which has gone up. To compute the return on invested capital, we need to calculate the after-tax EBIT, which requires an estimate of Global's tax rate, because net income is equal to pre-tax income, profit before tax, multiply 1 minus tax rate. We can estimate of 7.7 in 2018 and 5.4 in 2017, which has gone up. To compute invested capital, note first that Global's net debt was 3.2 plus 12.3 plus 76.3 minus 19.5 equal to 72.3 in 2017 and 95.5 in 2018. Thus, return on invested capital in 2018 was 6.5% and in 2017 is 5.8%. The improvement in Global's return on asset and return on invested capital from 2017 to 18 suggests that Global was able to use its assets more effectively and increase its return over this period. Okay, there is a question. Please do it by yourself at home. Yeah. The DuPont identity expresses the return on equity in terms of the firm profitability, asset efficiency, and leverage. For the year ended January 2017, Walmart had sales of $485.9 billion, net income of $13.6 billion, assets of $198.8 billion, and a book value of equity of $77.8 billion. For the same period, Target had sales of $69.5 billion, net income of $2.7 billion, total assets of $37.4 billion, and a book value of equity of $11 billion. Compare these firms' profitability, asset turnover, equity multipliers, and return on equity during this period. If Target had been able to match Walmart's asset turnover during this period, what would its return on equity have been? Okay, Walmart net profit margin from example 2.6 was 2.8%, which was below target net profit margin of 3.88%. On the other hand, Walmart used its asset more efficiently with an asset turnover of 2.44 compared to only 1.86 for Target. Finally, Target had greater leverage in terms of book value, with an equity multiplier 3.40 relative to Walmart's equity multiplier of 2.56. Next, let's compute the ROE of each firm directly by using DuPont identity, which okay. Note that despite its lower asset turnover, Target had a higher return on equity than Walmart due to its higher net profit margin and leverage. If Target had been able to match Walmart's asset turnover, its return on equity would have been significantly higher, would be around 32.3%. Okay, this slide shows the summary of all these ratios that we have. Profitability ratio, liquidity ratio, working capital ratio, interest coverage ratio, leverage ratio, valuation ratio, and operating returns. Okay, financial reporting in practice. Even with safeguards, reporting abuses still happen. Enron in 90s did a quite huge scandal. Also WorldCom. And in order to reduce the level of the scandals or the abuses in 2002 and 2010, the US came up with different rules for the more transparency, which is called Sarbanes-Oxley Act and the Dodd-Frank Act. Okay guys, that's end of this lecture. Thank you very much.